UK Crypto Crackdown, November 10th. £20,000 stablecoin limits explained. Welcome back to Mindful Money and Meals. I'm Felix, and today we're diving into a major shift taking place in the United Kingdom, one that could reshape how millions of people interact with digital money. If you thought crypto was entering a golden age of freedom, be prepared for reality. The UK is tightening the screws. On November 10th, the Bank of England, the Financial Conduct Authority, and HM Treasury triggered a coordinated push toward regulating stablecoins in a way the UK has never done before. It's one of the most aggressive frameworks we've seen from any Western regulator, and it includes something most people never thought possible: a £20,000 limit on how much certain stablecoins you can hold. Whether you hold crypto, use stablecoins for trading, operate a business, or simply watch the direction global finance is moving, this is a wake-up call. Banks, governments, and regulators are reclaiming control over digital money. So today, I'm breaking down what's happening, why it's happening, how this affects you, and what you must do before these rules come into full force. Let's begin. What exactly is happening? On November 10th, regulators in the UK released a set of proposals and consultations outlining a comprehensive stablecoin regulatory regime. This marks the start, not the end, of a bigger process, but it's the moment everything became official. Stablecoins tied to the British pound, especially those considered systemically important, will now be treated like parts of the traditional financial system. Here are the key points. Stablecoin issuers that could impact the wider economy will fall under the Bank of England's direct supervision. These issuers must maintain strong reserves, up to 60% in short-term UK government debt, and much of the rest as deposits at the Bank of England. Users, including ordinary citizens, may be capped at £20,000 of holdings in these systemically important stablecoins. Businesses may also face limits unless granted special exemptions. Exchanges and platforms operating in the UK must comply with new operational, reporting, and liquidity requirements. The consultation period runs until February 2026, but regulators made it clear this framework is moving ahead rapidly. In other words, stablecoins are no longer being tolerated as free-floating alternatives to traditional currency. The UK wants them regulated, monitored, and controlled. Why the UK is doing this? The timing isn't random. The UK is reacting to several major concerns. 1. Financial stability. Stablecoins have exploded in popularity, and regulators fear an unregulated stablecoin could crash and take parts of the economy down with it. A run on a major stablecoin, where everyone tries to redeem at once, could destabilize the British financial system. 2. Payment system integration. Stablecoins aren't just for crypto traders anymore. They're being used in payments, remittances, settlement layers. Regulators see them creeping into roles traditionally held by banks. 3. Market confidence. UK regulators want to avoid another Terra/Luna-style collapse that wipes out billions and evaporates public trust. 4th, competition and control. The United States is introducing federal stablecoin regulations. The EU has MiCA. If the UK doesn't act, it risks falling behind or losing regulatory influence. But let's be real. There's also an element of control. Governments do not want money circulating in systems they cannot monitor, tax, or regulate. Stablecoins challenge traditional financial power structures. That's why regulators are stepping in hard. Who is most affected? Let's break down who gets hit hardest by this crackdown. Individuals. If you hold UK-issued sterling-referenced stablecoins, you could be limited to £20,000. This may affect traders, investors, people using stablecoins as savings, and even those using crypto for everyday spending. Businesses, payment companies, exchanges, and trading platforms operating in the UK must now comply with complex reserve, reporting, and operational rules. Some platforms may delist UK stablecoins to avoid compliance costs. Stablecoin issuers. They will face the most significant burden: the requirement to hold large reserves in government-backed assets or deposits at the BOE will change their entire business model. Smaller issuers may not survive. Foreign stablecoins. Non-UK stablecoins might face restrictions too, depending on how platforms choose to adapt. If exchanges decide it's too risky, They may withdraw support entirely. This isn't just a technical rule change, it's a restructuring of how stablecoin markets operate in the UK and possibly beyond. Global comparisons and their implications. Let's look at the global picture. United States. The Genius Act introduces federal oversight for stablecoins used in payments. The US isn't capping user holdings, but it is regulating issuers heavily. European Union. MyCA provides a full legal framework for crypto assets, including stablecoins. Issuers must maintain strict reserves, transparency, and liquidity. UK. The UK stands out because of its holding caps. That's unusual. It indicates that regulators fear high exposure could amplify systemic risk. But it also shows that the UK is willing to limit individual financial freedom to protect economic stability. Implications. The UK might lose its competitiveness as a crypto innovation hub. Exchanges may move operations elsewhere. Stablecoins will increasingly resemble bank deposits. Central banks regain control over the monetary system. Investors lose some autonomy over their digital assets. The message is clear. Stablecoins will no longer exist in a gray zone. They will be absorbed into the regulated financial structure. What you should do now. Here are practical steps you must take to protect yourself. 1. Review your holdings. Identify all stablecoins you hold, where they are stored, and whether they're UK issued or foreign. If you are close to the £20,000 cap, plan ahead. 2. Consider diversification. Don't rely on a single stablecoin. Diversify into a mix of regulated assets, cash, or other crypto assets. 3. Assess exchange risk. Will your platform remain compliant? Many may delist UK stablecoins, freeze withdrawals, or impose new fees. 4. Prepare for liquidity restrictions. If regulations tighten further, exits may become slower or more limited. 5. Watch the consultation outcome. The final rules won't be confirmed until February 2026, but early preparation gives you freedom of choice. 6. Stay educated. The financial world is shifting fast. Stablecoins are transforming into regulated instruments, no longer the digital cash many believed they would remain. 7. Think long-term. This might be step 1 toward a UK central bank digital currency, CBDC. That could change everything. Plan with that possibility in mind. Conclusion. November 10th marks the moment the UK began reshaping the crypto world. Stablecoins are entering a regulated era, with caps, reserves, oversight, and structural changes that will impact investors, businesses, and the entire digital money ecosystem. If you're in crypto, now is the time to stay informed, stay agile, and make strategic decisions. If you found this video helpful, please give it a like, share it with friends and family, and subscribe for more deep dives into the hidden risks shaping our financial future. This has been Felix with Mindful Money and Meals. Stay mindful, stay curious, and stay prepared. See you next time.